Spot XRP ETFs just pulled in $385 million today. Add that to nearly $54 million yesterday, and suddenly this isn't noise anymore. It's a pattern. Institutions are not trading XRP, they are accumulating it quietly, methodically. And if this pace continues, OTC desks are going to face a serious problem very soon. Where does the next wave of XRP come from? Supply is getting locked up. ETFs are soaking liquidity. Regulation is inching forward. And global central banks are preparing digital currencies. All of this is happening while price barely moves. And that's exactly how the biggest shifts always begin. Because here's the reality most people miss. Price is the last thing to react, not the first. Flow comes first. Infrastructure comes second. Regulation comes third. Price comes last. And right now, XRP is checking boxes most assets never even get close to checking. We are now approaching $1.2 billion in cumulative inflows into spot XRP ETFs. That's not speculation. That's capital with mandates, compliance, and long-term intent. Even more important, we've now seen 23 straight days of inflows. No panic selling, no major outflows, no sign that institutions are flipping this for quick gains. This is positioning. Now, if you want to get beyond and truly unlock life-changing wealth with the 100x formula and spot hidden 100x stocks, use code Millionaire for a limited time discount. Link in video description. Over 600 million XRP is already locked up through ETFs alone. And while that might not sound massive at first glance, this is where it gets interesting. XRP doesn't need 10%, 20%, or 30% of supply locked to create pressure. At 1%, 2%, 3%, the dynamics change completely, liquidity thins, volatility expands, and OTC desks, which have quietly been feeding institutions without impacting price, begin to feel the strain. OTC desks don't have infinite supply. They started with inventory. Every ETF inflow drains that inventory, and once it dries up, there's only one place left to source XRP, the open market. That's when things stop being quiet. Now consider this perspective that really reframes the upside. Bitcoin ETFs have already proven that 11.5 billion can flow in during a single trading day. That actually happened. Now imagine even a fraction of that hitting XRP. If XRP were priced at, say, $6, that kind of day would absorb billions of XRP almost instantly. Even assuming only half is net inflow, which is conservative, you're talking about a supply shock that simply hasn't been modeled into price yet. And no, this isn't about XRP becoming Bitcoin. It's about capital behavior. Institutions don't care about tribal narratives. They care about liquidity, regulation, and utility. XRP is checking those boxes faster than almost any other digital asset. What makes this even more compelling is what hasn't happened yet. We haven't seen a single large outflow day. That matters. It tells us institutions are still building positions, not trimming them. And we're not done with ETF launches. There could be 10 to 15 XRP-related products coming over the next 3 to 6 months. Each one adds another pipe siphoning supply out of circulation. This is why price stagnation right now is not bearish, it's constructive. This is absorption. Now let's zoom out and talk about regulation, because this is another puzzle piece falling into place. Even if it's slower than people hoped in the US, the Clarity Act was expected to move faster. Instead, it's been delayed again, hearings pushed into the new year, potential votes slipping further, and realistically, we may not see full clarity until 2026. That frustrates retail investors, but institutions actually understand this pace very well. Financial regulation always moves slowly until suddenly it doesn't. The sticking points are revealing. Lawmakers are debating whether government officials should be allowed to profit from crypto ventures while in office. They're arguing about how much DeFi should be regulated without killing innovation. And perhaps most importantly, there's a growing battle between banks and crypto. Banks are worried, and they should be. If crypto platforms can offer 5 to 6% yields, while banks offer 0.25, 0.5% on savings, money doesn't stay loyal. Liquidity moves. That's why lobbying pressure is intense right now. This isn't about protecting consumers. It's about protecting legacy margins. But here's the key takeaway. Crypto is no longer fighting for legitimacy. It's fighting over market share. That's a completely different phase of adoption. Now let's shift to Europe, because what's happening there is just as important. The European Central Bank has officially completed its preparatory work on the digital euro. While the public launch isn't expected until later, the framework is becoming real. Legislation is expected to be finalized in 2026. Pilot programs may begin as early as 2027. And the ECB itself has stated it wants to be ready for issuance by 2029. That may sound far away, but in central banking terms, this is fast. What's more interesting is that some countries like Japan may move even faster. That raises an important point. Not all CBDCs will roll out simultaneously. Some regions may leapfrog others, and the infrastructure that supports interoperability, settlement, and liquidity will matter enormously. This is where distributed ledger technology and networks designed for payments quietly become essential. Now, CBDCs understandably make people uncomfortable. Surveillance concerns are real. Privacy matters. Consumer protections matter. But from a strategic standpoint, countries must be prepared. The worst position to be in is needing digital currency infrastructure and not having it ready. Europe understands this. The US understands this. The debate isn't if, it's how. And while governments debate, the private sector keeps building, which brings us to Ripple. There's been a lot of noise lately about Ripple's banking status in the US. Let's clear this up properly. Ripple has received preliminary approval to form a national trust bank. That does not mean the bank is live today. It means Ripple now has the green light to build it. That process takes time. Infrastructure, compliance, cybersecurity, staffing, reserves, systems. Realistically, this is a 9 to 12 month build out minimum. And because Ripple already works closely with the NYDFS, the same regulator that approved RLUSD, they're not starting from zero. This is also why XRP price didn't explode on the headline. This news isn't for traders, it's for banks. It's for institutions deciding who they trust to move value at scale. In finance, trust comes from regulation. And Ripple just gained a massive credibility upgrade. Brad Garlinghouse has already hinted that 2026 is where growth accelerates. That timeline aligns perfectly with regulatory clarity, ETF expansion, and infrastructure maturity. Big financial shifts never happen loudly. They happen quietly, then all at once. And this quiet build phase isn't limited to regulation and banking. It's happening at the protocol level too. Ripple's XDev team is actively expanding programmability on the XRP ledger, not by copying Ethereum, but by doing what XRPL does best: efficiency with purpose. Smart extensions and WASM-based modules allow developers to customize behavior without bloating the base layer. Smart escrows, conditional payments, and hybrid on-chain, off-chain logic are already becoming more flexible. This matters because mass adoption doesn't come from hype. It comes from functionality. Businesses need predictability. They need performance. They need tools that solve real problems without unnecessary complexity. And while all of this is building, macro conditions are quietly shifting in crypto's favor. Altcoins haven't had their moment yet, not because the cycle is broken, but because the business cycle has been subdued. Historically, when earnings rise and liquidity expands, capital moves out the risk curve. First large caps, then small caps, then alternatives. Crypto follows the same pattern. And looking ahead, there's a strong argument that 2026 brings a liquidity surge, fiscal stimulus, credit expansion, policy shifts. Whether you like it or not, more money in the system eventually finds its way into risk assets. That's not hype. That's how cycles work. So when you zoom out and connect the dots, ETF inflows, supply absorption, regulatory progress, banking integration, CBDC preparation, protocol development, and macro tailwinds, it becomes clear that XRP isn't reacting yet because it doesn't need to. The groundwork is being laid. When you look at the ETF data alone, it tells a story that price is not telling you yet. Institutions don't buy 23 days in a row by accident. They don't keep adding exposure unless their thesis is strengthening. And they don't do it without a long-term horizon. These are not trades. These are allocations. What makes this especially important is that XRP's supply dynamics are very different from most assets people are used to analyzing. A significant portion of XRP is already escrowed, locked, or strategically held. Add ETFs to that equation, and the liquid float becomes much smaller than headline supply numbers suggest. That's why even modest increases in demand can have outsized effects later. This is also why the OTC desk discussion matters so much. OTC desks exist to minimize market impact. They allow large buyers to accumulate without driving price. But they are not infinite liquidity pools. They work until they don't. And once they can't satisfy demand quietly, the market has to reprick to find sellers. That transition is rarely smooth. Now layer on what's happening behind the scenes with banks. Traditional banks are watching crypto infrastructure mature into something that starts to overlap directly with their core business: payments, settlement, custody, liquidity management. For years, crypto was easy to dismiss as speculative. That's no longer the case. When crypto companies begin operating under banking charters, using regulated frameworks, and integrating with legacy systems, the threat becomes real. This is why the debate around interest yield and stable coins is so intense. Banks are not afraid of Bitcoin as a store of value. They're afraid of losing cheap deposits. They're afraid of disintermediation. They're afraid of a world where money moves faster, cheaper, and more transparently without them taking a cut at every step. And that fear is driving regulation, not to stop crypto, but to shape it. The Clarity Act delays are frustrating on the surface, but they're also revealing. Lawmakers aren't asking whether crypto should exist anymore. They're arguing over details, over boundaries, over who gets what slice of the pie. That's a sign of maturity, not rejection. Markets that are ignored don't get regulated. Markets that matter do. Globally, the same pattern is playing out. The European Central Bank's work on the digital euro isn't about ideology, it's about relevance. If money becomes programmable, instant, and interoperable across borders, the institutions that fail to adapt risk becoming obsolete. That's why even countries that are cautious about CBDCs are still preparing them. Optionality matters. What's often missed in the CBDC conversation is that governments don't build everything themselves. They rely on private sector technology, standards, and rails. Interoperability, liquidity, and settlement layers will matter far more than the front-end branding of any given digital currency. This is where networks that are already optimized for payments become strategically valuable. At the same time, development on the XRP ledger continues in a very deliberate way. Instead of chasing every trend, the focus has been on extending functionality without compromising performance. Smart extensions, WAM modules, programmable escrows, these are not flashy buzzwords. They are tools that solve specific problems for enterprises that actually move money. This is not financial advice. That's the theme running through everything here: utility before hype. And that's also why the timeline matters. People hear 2026 or 2027 and tune out. But institutions don't think in months, they think in cycles. They position years ahead. By the time something is obvious to everyone, the easy gains are already gone. The biggest returns are captured during periods of doubt, boredom, and disbelief. This is also where macro starts to play a larger role. If liquidity expands the way many expect over the next cycle, capital will once again move outward on the risk curve. It always does. Large established assets first, then growth, then speculative. Crypto sits uniquely at the intersection of technology, finance, and speculation, which means when liquidity flows, it doesn't trickle in, it floods. Altcoins haven't had their run yet, not because the market is broken, but because conditions haven't been right. Earnings growth, fiscal stimulus, credit expansion, these are the ingredients that drive risk appetite. And there's a growing case that those ingredients return in force. When that happens, narratives won't matter as much as positioning. The assets that already have infrastructure, regulation, liquidity access, and institutional familiarity will have a massive advantage. XRP is positioning itself squarely in that category. This doesn't mean price goes straight up. Markets never move in straight lines. There will be pullbacks, delays, disappointments, and shakeouts, but the underlying direction is shaped long before charts reflect it. That's what makes this phase so critical and so uncomfortable for most people. The hardest part of investing isn't finding information. It's having the patience and conviction to act before confirmation. Most people wait until price validates their belief. Professionals position when belief is weakest and fundamentals are strongest. That's why you're seeing this disconnect right now. Strong fundamentals, quiet accumulation, muted price action. It feels wrong until suddenly it doesn't. And this pattern isn't unique to XRP. It's how every major asymmetric opportunity begins. Apple didn't look obvious before the iPhone. Amazon didn't look obvious before AWS. Bitcoin didn't look obvious under $1,000. The opportunity always looks unclear in the moment. That's the price of admission. True wealth comes from seeing opportunities most people miss and acting before everyone else catches on. My proven 100x wealth formula breaks it down step by step, showing you how to spot these powerful turning points early so you can multiply your wealth and unlock truly life-changing results. Stay patient, stay informed, and remember, the biggest opportunities are built quietly, long before they're celebrated loudly.